Investment basics, stocks, bonds, and compound interest. Let's be real for a second. Everyone wants to build wealth. But here's the catch. Most people don't actually understand how money grows. That's where investing comes in. Investing means putting your money to work. Instead of spending it now, you're letting it grow for the future. In other words, it's how the world's wealthiest people turn money they had into money that works for them. So, let's dive into the two most common ways people invest: stocks and bonds. Stocks. Owning a slice of a company. When you buy a stock, you're buying a tiny piece of ownership in a company. If that company does well, you do well. If it doesn't, well, your wallet will feel it. That's the risk. But here's the trade-off. Big risks can bring big rewards. There are two main ways you can make money from stocks. Dividends. Regular payments companies give to shareholders, usually 4 times a year. Capital gains. When you sell your stock for more than you paid. And thanks to online brokerage apps, you don't need to be a Wall Street pro. Anyone with a phone can start investing in the stock market. Bonds. The safer bet. Now, let's talk bonds. A bond is like an IOU, a promise. When you buy a bond, you're lending your money to a company or the government. In return, they promise to pay you back later, with interest. Bonds are generally safer than stocks. You're not betting on a company's success, you're loaning money. Each bond has 3 key parts. Coupon rate, the interest you'll earn. Maturity date, when you'll get your money back. Par value, the amount that'll be repaid. Simple, right? Safer? Usually, but the trade-off, less reward. Behind all this is something huge: the financial system. It's the network that connects savers and borrowers. When you put money in the bank, you're not just saving, you're actually helping fund someone else's loan. Banks, mutual funds, and pension funds act as financial intermediaries, basically middlemen that move money around to keep the economy running. A mutual fund pools money from lots of people and invests it in different assets, giving you diversification without all the work. A hedge fund? That's like investing on steroids. Risky moves, huge profits. Or not. It's usually a playground for the super wealthy. And a pension fund helps retirees live comfortably after years of work by investing on their behalf. Here's a golden rule. Don't put all your eggs in one basket. The smartest investors diversify. They spread their money across different stocks, bonds, and funds to reduce risk. And the second golden rule? Start early. Why? Because of the magic of compound interest. Your money making more money on itself. Simple versus compound interest. Let's break this down. Simple interest only pays you based on your original investment. Compound interest pays you interest on your interest. It's money that grows, on autopilot. The formulas look like this. Simple interest. A equals P times open parenthesis 1 plus R T close parenthesis. Compound interest. A equals P times 1 plus R over N to the power of NT. But you don't need to memorize that. Just remember, compound greater than simple. Always. Here's an example. If you invest $10,000 at a simple interest rate of 5% for 5 years, you'd earn $2,500. But if it's compound interest, compounded monthly, after 5 years you'd have $12,833.59. Same money, same rate. But time and compounding turned it into more. That's the power of starting early. Every investment is a balance between risk and reward. The higher the potential return, the higher the risk you're taking. Your mission as an investor? Find the balance that fits your goals, your timeline, and your comfort level. And speaking of risk, next up, we're tackling one of the riskiest ways people borrow money: credit cards. Don't miss it.